Hello and thanks for joining us on Kalkine TV for Smart Market Insights. I'm James Preston, and in this edition I'll be taking a look at how investors can minimise harm to their portfolios amidst the backdrop of the Ukraine crisis. Equity markets across the globe witnessed a bloodbath last Thursday when Russia launched a full-fledged attack on Ukraine. Friday saw most of the global markets wallow in a sea of red. However, the next day, investors also witnessed a very sharp bounce back, despite more sanctions being imposed on Russia and its continued invasion of Ukraine. Although this kind of volatility is unusual, so is an event like a country's invasion. To protect your portfolio, there's a number of actions you can take though. First and foremost, diversification is a must. Diversification is one of the simplest yet most effective ways to reduce your portfolio drawdowns. It simply means investing in various sectors or asset classes, thereby helping to cut down the concentration of any one sector or asset in the portfolio. This technique is based on the assumption that not all the sectors of the market or different asset classes generally tend to fall at the same time. The best example is the recent Ukraine-Russia conflict, wherein almost all of the world's equity markets have tanked heavily. Still, commodities such as natural gas, crude oil and gold have in fact all surged massively. Therefore, having exposure to these commodities would have negated some of the losses that arose from equity markets themselves. Another strategy to implement is hedging your portfolio. Hedging means investing in two different assets of securities that are inversely correlated to one another. The simple premise is that an investor tries to reduce the risk of loss by making a counter position in a security that would likely gain if the hedged security falls. It's a slightly different option to diversification, as diversification does not necessarily have to be in inversely correlated assets. For example, an investor can invest in technology and real estate stocks to diversify their portfolio. Still, it cannot be termed as a hedged position unless an inverse correlation between the two sectors can be established. Opting for low beta stocks is another strategy investors can utilise. A low beta stock is the one that has a beta value of less than 1. Beta is simply a measure of volatility, which is established after comparing to a market as a whole. In simple terms, the lower the beta value of a stock, the slower and more steadily it's expected to move in either direction, whereas high beta stocks tend to move and be more volatile than within the broader markets. It's also a no-brainer that low beta stocks would help a portfolio become more sustainable, as opposed to having more volatility or high beta stocks during these volatile times. Generally, small cap stocks have a very high beta value. During high geopolitical tensions such as the current Russia-Ukraine war, investor confidence also tends to worsen. Although losses are very difficult to completely avoid, implementing these strategies can indeed help ensure that you safeguard your investments. Alright, well that's all for this edition of Smart Market Insights. Another episode coming your way tomorrow. And until then, make sure to keep it locked on Kalkine TV for 24/7 coverage of the latest market movements and business news. I'm James, signing off for now.